Ready to pass the CPA exam faster? Visit cpapass.ai. Today, how external factors and industry downturns trip up AUD candidates. Many CPA candidates fail the AUD section because they treat auditing like a pure math test, jumping straight to checking the numbers. But auditing standards, specifically AUC Section 315, require you to perform risk assessment procedures first. You must understand the entity and its environment before you can design effective substantive tests. Skipping this foundational step is like a doctor prescribing medication without diagnosing the patient. On the exam, this mistake leads directly to missing major risks of material misstatement on task-based simulations. If you do not understand the business context, you cannot identify where errors or fraud are most likely to hide. We must build the foundation first by analyzing the client's external and internal environment. To understand a client, we start with the external environment. Think of this as reading the economic weather forecast. Just as a ship's captain must know the weather before assessing a vessel's safety, an auditor must evaluate the industry conditions and macroeconomic factors before testing balances. External pressures dictate client behavior. For example, if you are auditing an oil company and global oil prices drop by 50%, that is a massive external risk. This downturn pressures management to overvalue their oil reserves or delay recognizing impairment losses to keep their financial statements looking healthy. Understanding this outside pressure helps you spot where management is highly motivated to make aggressive accounting choices or commit fraud. Next, we must analyze the regulatory environment and technological disruptions. Regulatory frameworks vary wildly across industries. A highly regulated financial institution faces strict compliance rules and oversight, whereas a local retail business operates under standard commercial laws. Auditors must evaluate how changes in legislation, tax codes, and government policies translate into direct financial risks. Additionally, technological disruptions or outdated information systems can create severe operational pressures that threaten a company's going concern status. If a client's technology is obsolete, their business model may fail or their internal controls may break down. Your job during audit planning is to identify these regulatory and technological factors to determine if they create a high risk of material misstatement. Let's address a major examiner trap: confusing business risk with audit risk. Examiners love to ask if a business risk, like a competitor launching a superior product, automatically requires a qualified audit opinion. The answer is absolutely not. Business risk is the threat that a company will not meet its strategic goals. Audit risk, however, is the risk that the auditor expresses an inappropriate opinion on materially misstated financial statements. While they are different, they are deeply connected. A business risk like declining demand for a product directly leads to an audit risk, such as inventory obsolescence or asset impairment. Always connect the business threat to the specific financial statement account that might be misstated. And we must also examine how the entity measures its financial performance. This includes reviewing internal key performance indicators and external metrics, such as bank debt covenants. Debt to equity covenants and performance-based executive compensation create powerful incentives for management to manipulate financial results. For example, if a CEO's contract triggers a $500,000 bonus, only if net income exceeds $2 million and the actual pre-adjusted income is $1.9 million, the risk of aggressive accounting spikes dramatically. Management has a strong incentive to accelerate revenue or delay expenses. As an auditor, identifying these performance measures and compensation structures tells you exactly where to expect bias and potential management override of controls. To synthesize all of this for the CPA exam, use the INAMO mnemonic as your systematic risk assessment framework. INAMO stands for industry, nature, accounting policies, management objectives, and observation of performance. Remember the golden rule: know the outside, which is the industry, know the inside, which is the nature and management, and know the accounting policies and estimates. Applying this structured framework ensures you do not miss critical risk factors on exam day. To master these concepts, head over to cpapass.ai to practice realistic multiple choice questions and task-based simulations. By systematically evaluating these 5 areas on every simulation, you will easily avoid examiner traps and confidently pass the AUD section.